Welcome to Sikich. This is the latest Sikich webinar series. We are calling this Tax Reform Reset. This will focus on recent comprehensive tax legislation passed by Congress. My name is Jim Brandenburg, a tax partner at Sikich, and I will lead our discussion in these webinars. Okay, you probably heard about tax reform and wondered about what is this Tax Reform Reset. Let me introduce this series and offer some background. The Tax Cut and Jobs Act was signed into law in December of 2017. This legislation brought about comprehensive tax reform in many significant areas. It was the first major tax reform in over 30 years. There were across-the-board changes for businesses, both large and small, in all industries. These major changes, however, were ushered in Congress in a short time frame. When it was signed into law, there was much fanfare, but also some uncertainty for many businesses and taxpayers as they wondered what all these changes meant. Anytime there is tax legislation and changes, it's important for businesses and taxpayers to learn about the changes, find out the effective dates of these changes, understand the impact to their tax situation into their business, and lastly, to consider any tax planning opportunities. But with all these significant changes in the Tax Cuts and Jobs Act, many taxpayers and businesses were unsure what to focus on first, second, third. This might vary from one business to another, but each was asking what was most critical to analyze and what changes were perhaps less important. What made this process even more challenging was that while this legislation moved rapidly through Congress, any IRS guidance was slow to follow. Taxpayers and businesses wanted to make decisions, but they had to wait. The IRS was tasked with tackling significant guidance projects in dozens of areas of this new tax law, and they did an outstanding job with that given the complexity and comprehensive nature of the bill. Gradually, the IRS released guidance in many areas, and yes, there is still more guidance coming. So we felt it was important to hit the reset button on tax reform. There were so many changes in a short time frame, much uncertainty, and many complexities. We wanted to take a step back and let's see what we've learned so far with tax reform and what remains. It's important for us to explore the tax planning opportunities in tax reform bill, to rethink the impact of some of these changes, identify several pitfalls in the bill, and also explain some lesser known provisions that perhaps have flown under the radar and you haven't heard much about. It is essential for you as taxpayer and business to realize that it's not too late to evaluate tax reform and adopt some new strategies. Even if you have not done anything on tax reform or done very little so far, you can still benefit from a review of this tax bill and the impact on your business and you individually. You can still realize some of these tax savings now, but you need to get started. And that's the focus and emphasis of this tax reform reset and this webinar series. Okay, as we get started, it's important to look again at this tax reform bill, the Tax Cut and Jobs Act. Again, a comprehensive tax bill, the first in over 30 years. There were four main stated themes in the tax cut bill. First, to make the U.S. companies more competitive with the rest of the world. Secondly, to grow the U.S. economy and create jobs. Next, to provide middle-class tax relief. And fourth, to simplify the tax rules. What we focused on in the first of our Tax Reform Reset series was the drop in the tax rates. We looked at the change for corporations as well as pass-through businesses and what advantages and opportunities were out there. Our second series looked at some of the changes for businesses and some of the new deductions available for business from tax reform. And in this session, we're going to look at some of the changes in tax reform that apply to individuals that they can take advantage of or be aware of. Okay, let's get started with it and look at some of these individual changes. First is a change in the tax rates. Again, for individuals, the tax rates were not cut as much as the corporate tax rates. Corporate tax rates, as you may recall, dropped from 35% down to 21%. Again, for individuals, not as much of a change with that. You can notice here, we'll talk about the top individual rate dropping down to 37% from 39.6%. So just be aware that there are some reductions, but not as much as with businesses. These changes are effective in 2018, but they sunset in 2026. So be aware that these changes are not permanent, as the corporate tax rates, those changes and the reductions in the corporate ones were permanent. We now have 7 tax brackets, as you can see here, 10%, 12, 22, 24, 32, 35, and a top rate now of 37%. One thing to note with these tax rates, however, is that the income in those brackets has been expanded. So there's more income at each of these brackets before we get to the top range, which again will provide some tax savings and some tax reductions for individuals. Another thing to note is that the marriage tax penalty, which had been unfortunately part of the tax code for a number of years, has been eliminated for the most part for most of the tax brackets, but again, it still applies a little bit for the top 2 tax brackets. So married couple will have approximately twice what the 2 single tax brackets will have, but the marriage tax penalty has been greatly reduced, if not eliminated, for many taxpayers. A second item to note that's important is capital gains. There was some question whether capital gains would change in tax reform. The rate did not change. And generally for long-term capital gains and qualified dividends, the rate stays at 15%. Some taxpayers in the top brackets may get a 20% rate applies to them, but those in the bottom 2 tax brackets, make sure you remember that those pay 0% on long-term capital gains and qualified dividends. Okay, here we've got a summary here of the tax brackets. Again, the new rates that I mentioned here, and you can see that the income ranges have been expanded or stretched out here. So you'll have income tax at these slightly lower rates, but over more income level with it. Again, we start at $19,000 approximately for the bottom 10% bracket and go up to $600,000. And again, over $600,000, the new rate is 37%. And again, this is for a married couple filing a joint tax return. These brackets are also indexed for inflation, so you will see those rates for 2019 and going ahead to 2020 will be indexed for inflation. Okay, another thing that changed for individuals beside the change in the tax rate is some of the deductions. Just as we went through with some of the changes in the business deduction, there were changes for individuals as well. And this just highlights some of the itemized deductions that many of you are familiar with on your Schedule A. We'll go through that. We'll spend a little more time with the state and local deduction. Again, significant change with that SALT or state and local deduction. Mortgage interest expense had some changes with it. Just to note that the for acquisition debt, a new home used to have a $1 million acquisition debt limit. That's been decreased to $750,000 for new mortgages, so be aware of that. Also, any home equity loan interest, which was allowed up to $100,000 of debt that you could have, that's also been curtailed, so just be aware of that. And there were no grandfather dates on that home equity loan, so just be aware that's got to change here starting in 2018. Charitable contribution deductions essentially were unchanged. They really did not change charitable contributions, so those are still deductible for individuals. What they call other miscellaneous deductions that were subject to a 2% limitation of your adjusted gross income, those have been removed or repealed, so those are no longer deductible starting here in 2018. One thing to note though with your itemized deductions is that the standard deduction has been increased. That for a married couple, it's up to $24,000 in 2018, and index for inflation will be $24,400 here in 2019. Again, for a single taxpayer, it's half of those amounts. Again, what you do is you look at all your itemized deductions, compare it to the standard deduction, and take the greater of those two. And we'll go through an example with that in a minute. But again, the standard deduction was approximately doubled through tax reform. Another item to note that received a little less attention was the repeal of the exemption. The exemption for yourself or a spouse or dependent exemption for your children, that is no longer available starting here in 2018. One thing to note with that, however, is that the child tax credit, which had been $1,000, is now doubled to $2,000. So you have a higher child tax credit available. In addition, the range of where that credit was phased out, they used to phase out the child tax credit. The income level for that phase out range is much more, has been increased significantly. So any couple with qualifying child tax credit will much more likely be able to take advantage of that credit because of one, the higher credit, and two, the higher income range for that credit. As I mentioned, the state and local tax was one of the more significant changes in itemized deduction, or the state and local tax, also refers to as the SALT deduction. That has a cap now of $10,000 for an individual. That again covers the state income tax as well as their property tax. Again, a $10,000 starting here in 2018. Now there's some higher tax states, New York, New Jersey, California, and some others that tried to get some workarounds, if you will, that would get around those new caps, those new limitations. There's two workarounds that have been looked at over the last year or so. One is what they call a charitable workaround. And with that is what the states tried to do is put in a program where people could make a donation, a charitable contribution to the state and treat that as a charitable contribution. Then they would get a credit on their state income tax for that amount that they gave to the state. Well, this was set up to try to convert a state tax payment, which is limited in its deduction again to that $10,000, into a charitable contribution, which did not have any limitation. Another workaround that was put out there was what they call a pass-through entity workaround, where if there's income from a pass-through entity, an S corporation or a partnership, they would have the entity or the business pay the income tax related to that business, rather than have the individual pay that tax and have that be deductible without this $10,000 limitation. A number of states, including Wisconsin, Louisiana, Connecticut, Oklahoma, and some others, have tried to use this pass-through workaround to that $10,000 cap. So what the IRS did is the IRS issued some guidance on it, issued some final regulations this year in June. And what they did is disallow the deduction for those charitable workarounds. And they indicated that the IRS would indicated that amounts that would otherwise be deductible as charitable contributions must be reduced by the amount of the state and local credit received. So the IRS is saying that you're not going to be able to use that charitable workaround to get around that state and local deduction if you're in those states that have that program. Those states, though, are going to challenge that regulation and look to either in court do that or maybe to have Congress change their rule. But that's something to keep an eye on. But the IRS does not look favorably upon those charitable workarounds. The IRS, however, did not deal with the entity level workarounds. So those states, including Wisconsin and others who have that, they did not address that. They did not rule favorably or did not rule unfavorably with that. But that's something to keep an eye on if the IRS does issue guidance on those entity level workarounds. So one thing to note, though, is until the IRS does rule on that there may be a planning opportunity available. States, as I mentioned, Wisconsin is one that has the entity level workaround. So again, for an S corporation or partnerships, there's an annual election that is made. You need the consent of more than 50% of the owners. And that may provide savings. Again, there are many considerations to look at with this election, this annual election that you have, but it can provide approximately a 2% permanent savings based on the income of the business. So that's something to take a look at or check with your Sikich tax advisor if you want to explore that opportunity. So I mentioned before about the higher standard deduction as well as the change in itemized deduction. So I thought I'd go through an example now of the impact of what we refer to as bunching your itemized deduction. Again, the higher standard deduction starts here in 2018 going forward. So the idea is to bunch or group your itemized deductions into 2 years and then take the standard deduction in the other intervening year. Okay, so what you look at is then what would be the overall savings that you'd get in that 2-year tax period. So here's our example. We've got Stan, a taxpayer, typically has $14,000 of property and state and local taxes in a year, also has $16,000 of charitable contributions per year, and has no mortgage interest. Under this new tax law, taxes, again, are limited to $10,000, that new SALT limitation. So the itemized deduction would be $26,000, $10,000 for state and local and $16,000 for charitable. So over the 2 years, Stan would have $52,000 of itemized deduction. If Stan, however, decided to bunch those itemized deductions, he would not do anything to bunch his taxes. Again, he would still get $10,000 annually. But if he bunched his charitables and had $32,000 in 1 year and nothing in the next, what would happen with that? So let's look at the result. If Stan did this, in year one, he would have $42,000 of overall deductions, $10,000 for taxes, and then $32,000 for the charitables, which again reflects 2 years of charitables in that first year. In year two, Stan would still have the $10,000 of taxes, but would have no charitables. Again, those have been paid in year one, but would be allowed instead to take the standard deduction of $24,400, again for 2019. So over this 2-year period, Stan would have $66,400 of total deductions, or approximately $14,400 more than if he had not bunched. Okay, that $14,400 of additional deductions could amount to maybe $4,000 to $5,000 of tax savings, again, depending on Stan's tax bracket. The key with this bunching is to realize that you have the same cash outflow over that two-year time frame. You just change the timing of when you're paying those deductions. And again, charitable contributions is a key item to look at when trying to bunch those charitable and your itemized deductions. Okay, another change that's really not an itemized deduction, but it's one that, again, perhaps has received a little less attention, is there's a new limitation on what they refer to as excess losses. And they have a new section 461L that deals with that. And what the tax reform added was this new loss provision. In the past, again, once you went through some of the general limitations for making sure you had enough tax basis and at risk for a loss, you were allowed to take the loss that you had for the business. The tax reform, however, imposes a $500,000 loss limitation per year for married couples and $250,000 for a single taxpayer on losses they have in a year. Those are indexed for inflation. Again, for 2019, those are bumped up a little bit to $510,000. And these apply at the individual level, not at the partner or share, not at the partnership or S corporation, but at the individual shareholder level. It's not an entity level limitation. Now note, if you actually have a loss that exceeds these amount, that excess amount will be carried over. It's not lost. It will be treated as a net operating loss, but you can still get it. It just may be a year or two down the road before you're able to take advantage of that loss. One thing to note is that there's no IRS guidance yet or limited guidance. All they have is the instructions, and those differ a little bit from what the Joint Committee in Congress had for this new limitation. The IRS instructions with the form are actually a little bit more favorable than what the Congressional Committee had thought for this new limitation. There is a new form 461 that you will need to complete to take advantage, or at least have this limitation applied to you. So be aware of that. That's new starting here in 2018 going forward. Again, with this, if you had anticipated with your business that you have a loss that's much larger than that, be aware that you're not going to be able to take the full loss here starting in 2018 going forward. So that loss will not be lost, quote, permanently. It will carry forward, may be able to use in a future tax year. Again, there are a number of unanswered questions, and hopefully the IRS will issue guidance on that soon. Again, this starts in 2018. It does sunset after 2025, so be aware of that new limitation. And the last item I'd like to go through here for individual changes is the alternative minimum tax. Many may be familiar with it. It's been an irritant for many taxpayers and even tax practitioners. It has a number of complexities, some additional forms and reporting that's involved. It's frustrated taxpayers over the years with it, not understanding how it applies and the additional tax that it resulted in. Congress wanted to repeal this outright, but the Senate and with some of its budget rules prevented them from repealing it. So AMT remains for taxpayers. But the impact of AMT was lessened with tax reform. Congress made two changes to, I think, ease the burden or the pain of AMT. First, they raised the AMT exemption for married couple up to about $110,000 for 2018 and going forward into 2019. Also, they increased the point where the AMT exemption is phased out, and it's over $1 million here in 2019. So both those changes had a significant impact of reducing the number of taxpayers subject to AMT in 2019. They still need to file the AMT forms, but the actual tax impact of AMT has been greatly reduced or softened starting in 2018. Again, the effective date is 2018 for this. It does have a sunset date in 2025, meaning that if Congress does not act, AMT will go back to the thresholds from 2017, those prior thresholds, beginning after 2025, and that could have a significant impact on taxpayers. So again, something to be aware of, but at least in the short run here, AMT has been greatly reduced and minimized. Okay, so this ends the comments here with some of the tax reform changes and some of the impact for individuals. Again, we appreciate you joining in on these sessions. Again, this continuing series we refer as the Tax Reform Reset, covering changes for both businesses and individuals. We invite you also to please check out our Tax Reform Hub on Sikich.com, where you can find some additional information, articles, and some latest summary on tax reform. Again, even though tax reform was almost past 2 years ago, the IRS continues to issue some guidance on that, so that the taxpayers and businesses need to be aware of some of those changes. So we cover a lot of those items on Sikich.com, so take a look at that. We appreciate you joining for these webinars. Thank you very much.